So today we're going to go over how recession, inflation, tightening of money impacts credit, loans, and what kind of credit scores now lenders are requiring. One thing we know with the recession, inflation, tightening, whatever we want to call this here in 2022, our lenders are changing their credit grades. I want to go over and show you what that means, kind of behind the scenes, what loan officers, underwriters look at. The one thing to understand is the money is just a product. There's someone out there who has the money who wants to lend it out. When things tighten up, when things change, they change the rules, and all the lenders, the brokers, they just have to abide by them. I'm going to show you exactly what they look at so you could see how credit impacts not only what you could get as far as the loan to values, but your rate, your requirements, and even your options, even if you have options, as credit has really come into focus during this recession. So first of all, I'm going to show you exactly what loan officers and everyone look at. They look at a scale when they're pricing out a loan. They get this from the underwriters, from the company, from the people who have the money, and this is what they have to go off from a loan. What you see is the loan to values that they will lend on based on the credit scores. This is for a hard money lender, a national hard money lender. What you're going to find out is now credit scores, the minimum is 680. That used to be 620. What's happened is the people from 620 now to 679 don't have an option with this lender for hard money. What also happened is the loan to values. Now they'll lend up to 80% of the cost, the loan to value, or 75% of the ARV. So almost all lenders were at 90%. Now they've gone down to 80%. This is the impact that credit has when everything tightens up, which means there's less money available. So they're going to make it harder for people to get it with scores that are lower. This is what we're talking about, raising those scores, keeping those scores up so you have more availability for credit. And then you're also going to see the rates. We all see the impact, what's happening with rates. This rate, when it used to be 90% and the higher LTVs was in the 7s. So we've gone up almost 3%, 2.5% over the last 6 months. Credit scores have gone up, requirements. How much they'll lend you has gone down. Rates have also gone up. This is what we're seeing in hard money, and this is what the mortgage people, the brokers, even the direct lenders read off of, go off of, to actually make a decision to price something out, the terms that you see on the hard money side. Quickly, on the traditional side, longer term, anything for investors, what you're going to find here is that they've eliminated all options for anybody under a 680. So it used to be 640, you could get something, even 679, you just pay more. What a lot of lenders are doing right now is just eliminating them. So you don't even have those options. You do need to work on your credit for the hard money. You also have to work on it for the long-term stuff. You can also see the impact on credit scores, even from a 680 up to a 740, just on rates. So in this case, what they're doing is they're adding about 750 basis points. That's almost a point to you, not in rate, but in cost. So that typically means you're going to pay anywhere between 1/4 and 1/2 a point higher in rates. Credit score matters. If you want the best rate, you want the best leverage, you're going to have the best credit. The last one I'm going to show you is a DSCR loan. If you're in real estate investing, you've come across these. These are the stated deals. And once you're going to see, again, it's just what's happened over the last 2 to 3 months. They've pretty much eliminated on all lenders anything below the 680 score. So you're going to have to go to more private money, hard money, and it's going to cost you a lot more. As you see also, even from here, where they go from 680 up to 760, just the difference in cost. So you're paying 1.125 points higher. That's origination, not actually rate. The cost of everything you do will actually increase, but it's also tightening. So if you don't have the credit score, it's going to not only impact your deal flow, because you may not even be able to get deals, but it is going to impact your cash flow, and not only the money that you're bringing in every month if it's a rental, but also how much you have to put out. So on every deal, maybe you're putting out another 10 or 15%. Work on your credit. We're going to go through a couple other examples today just to see how the recession is impacting you and how credit can either make it easier or harder. Now we're going to go over how credit is impacting deal flow and cash flow. We went over exactly kind of a behind the scenes look at what underwriters and mortgage people have to go by, the grid, what the money people are telling them the new requirements are. But how does that relate to actually money coming into you or money going out? What we're seeing, especially with credit scores below 680, if you could even get a loan, you're going to have to put in another 5 to 15% on top of what you're already putting in. If you had a hard money loan that you were putting in 10%, now you may have to put in 25%. That means on a $200,000 deal, you're going to have to now come up with $50,000 to put into that deal. Every time you have to put more money into a deal, that means you're going to be able to do less deals. That doesn't matter if it's a flip, doesn't matter if it's BRRRR, because the long term and short term have both tightened up, meaning there's going to be more money out of your pocket and required. In these situations, over the next year or so, you may have to look at something like gap funding, and we have some great videos on that, because you may need more money from other sources. But the one thing you're going to need to understand is if your credit score is below 680, you're more than likely going to have to start putting more money into each deal. It also means that each deal that you do that's a BRRRR, or even if it is a flip, you're going to be paying more in interest. So if it's a flip and you're paying more in interest, that means your margins have come down. If it's a BRRRR and you're paying more in interest, that means your spread has come down, your cash flow. The higher your credit score, the less you're going to put down, the better rates you're going to get. So that means cash flow in both ways, cash flow not flowing out to put into the deals, and the monthly cash flow that you're bringing in. So you're either keeping more or you're paying the lender more. We want to make sure you're working on your credit, focused on your credit. The people with the best credit are going to get the best deals in the near future. The tight money is here. The easy money has disappeared for a while, and it might come back maybe first quarter, second quarter. But right now it's tight money. Make sure you're working on those credit scores. I think it's best that we just look at real numbers when we're talking about credit score impacts. But what does that look like? Because sometimes when you look at it, we're going to have an example here of a $300,000 loan. And we're going to start out with a normal rate as of today for an investment property, 6%. So what you're going to find is that payments right around $1,800. If your credit score is 20 or 30 points less, you're going to be down in this 6.5. And you say, well, it's not that big an impact. It's only $100 a month. But that's $100 a month. But what happens, especially now, if you're in that 660, 640, you're going to have to go to non-traditional or even private money. Your cash flow is going to be impacted even more. The cash flow for you compared to someone up here, they're going to be able to buy more properties because more properties will cash flow at these rates over these rates. And that $615 is just money that you're giving to the lender instead of putting it into your life. What do those numbers look like though yearly? After a year, that's going to cost you, every year it's going to cost you about $1,150. Over 30 years, it's going to be $34,000. If you're not taking care of your credit, if you're not getting it up, moving it up the scale, a $300,000 property could cost you an extra over $200,000 in interest just because this person's credit score is a lot higher than this person's. Take care of your credit. We have some great videos on exactly how to get your credit up. If you need to work with a credit person to get everything in line, do it now because in 2023, prices are going to come down, opportunities are going to be there, and you want to be able to make sure every property cash flows and cash flows in your best interest. Let's take these examples out even farther and say like now we have 10 properties. We actually have a portfolio of properties. We just don't have one. How does that impact us if we have 10 properties? So you have 10 properties, you go from 6 to 6.5, over 30 years, you're spending an extra $349,000, taking that money out of your life, putting it into the lender's life. Once you get into that 660, 640 credit scores and you're down into rates that are 2, 3, 4 points higher, look at what happens. You have a portfolio of 10 properties totaling $3 million. You just spent an extra $2.2 million in interest. That's just on top of everything else you spent. If you want to make life easier, if you want to make it more profitable, you really do have to at least focus on your credit, getting it up every step that you can, because it does impact your cash flow. it does impact when you can retire and your net worth, because this person can pay off a property a lot faster than this person. The person at 6%, more properties cash flow, more opportunities are there. We need to work on our credit because it's money coming out of your pocket. It is a disadvantage, but it also can keep you from properties. Not only that properties that cash flow for someone else but don't cash flow for you, but another thing is when they're calculating if you qualify, if your debt to income works, if the DSCR works in that property. Because remember, if you have a higher interest rate, your DSCR payment's going to be higher, so it may not qualify. The credit impacts you also in the underwriting. You may not even qualify for that loan because the rate has now kicked you out of the DTA or out of the DSCR. You need to really look at the impact that credit has in your life, in your investments, so you can put more money into what you love and less money into the banker's life. It just makes it so much easier. We have a couple great videos on how to fix that credit, impact that credit. And like I said before, we'll put those here because I think it's very important you take care of that now before the end of the year or the beginning of next year. If you have bad credit, what are your options for real estate investing, especially during a recession? Number one, what you're going to find is your traditional, from hard money to conforming to even DSCRs, have probably been cut at least in half, probably 60 or 70% down. The products you're going to be limited to have now become 10% of the options that someone with like a 700 score has. So understand that. Understand you're going to have to shop around more, look around more. You're going to pay more in down payments. Lower loan to values, probably 10 to 15% less on those transactions. It's still doable. You just have to understand where you sit. You're also going to pay anywhere between 1% and 3% higher in interest rates. That will impact your cash flow. That'll not only impact if you want to do a deal, but if you qualify for a deal. So you have to look at those. This is the time that you may need to look at some unique financing and finding properties, from subject twos to owner carries, where it doesn't matter where they look at your credit, where they judge you on how things have been taken care of. They just want someone to come in, take care of a property, and do this. Maybe you need to look at some of those options, but you also need to look at getting your credit in line, getting your credit into the 700s, because that's really where you're going to impact your investment career on the money side. We're always talking about the money side. We say there's money in the money because there is money in the money. As you saw before, there's up to $2 million extra some people pay in interest just because they don't take care of their credit. So we want to make sure you're taking care of your credit so you have the advantage. Get the properties that everyone else has too. But if you don't, really look into subject twos, really look into owner carries, anything you could do to get the ball rolling, I would say get the ball rolling. How do you improve your score? If you're looking to improve your score, there's a couple quick ways, especially if it's just about how you use your credit. In real estate investing, there's a lot of flippers. There's even a lot of people who are getting started who use their credit cards. That you over leverage everything, and that impacts your credit. That's about a 30% impact on your credit when you have over a certain balance limit. So a couple of the ways we've always suggested, number one is to go private. If you can borrow money from family, friends, whatever, to pay off those credit cards, even if it's for 60 days, take them off your credit so it does not impact your credit score. It'll actually make it go up because your usage will be in line. That would be number one that I would try. Getting those credit cards and those balances off what is reported into something private. And then just pay it back later, put it back in your cards, whatever you have to do. You still have to let your lenders know that you have that debt, but it doesn't impact your credit score. If you have thin credit, if you have little credit, get authorized on someone else's account. That means going into a family, friend, whoever who has good credit, who will get you authorized on their credit card. You never have to use it, you never have to look at it, but what you do is you get to use their credit history on that card. It positively impacts your credit and can do it quickly. Also, if you are where you had a bunch of cards, because we've talked to people who had 30, 40, 50 credit cards, pay those off, get them down. When you do that, don't close them. Don't close at least all of them, because having that credit out there, what it does, especially if there's zero, is it increases your availability. Remember we talked about first was getting those credit cards paid down because the usage is too high. Another thing is the more available credit you had compared to usage, the better you'll be. Someone who has $1,000 in credit cards out, all they have available is $1,200, will be impacted more than someone who owes $1,000 and has $5,000 available. The FICO scores, the credits, they look at that completely different. Even though it's the same amount of debt, and the person can actually get in more debt over here, the person who has a more available credit will have a better score. We have some great videos and techniques, and we'll put some of that information below. But what we're coming to is working on your credit. If it's something that is just a habit and you don't pay it, I think you have to change that habit if you want to really make good money in real estate investing. And if it's just something that you're just learning about credit, dive in, check out our videos, check out other videos, but get educated and get your credit up to the scores that you need to be one of the prime investors. If you have any questions, comments, let us know. Share this video if you know someone else who's struggling, needs some help with their credit. Subscribe, like, it helps us, it helps the community around us. We'll put a free download below on some of the quick, easy ways to help your credit and fix your credit. We really want to see your credit score go up. We want to see more investors who have the ability to take advantage of this market. This market is going to be very good coming forward. Prices are going to come down. There's going to be a lot of money made. We want to make sure you are one of the people making that kind of money.